Hello, I'm Liam Donohue from Lennox Capital Partners, and over the next few minutes, I'll take you through a summary of what we saw during August 2025's reporting season. For the next few slides, we're going to cover off a bit of a summary from the FY25 reporting season that just completed last month in August. And one thing that's always really important to us through reporting season is obviously the earnings that companies deliver, but then also what reactions we see in terms of consensus estimates following those earnings being delivered. And the two charts on the slide here try to summarize both of those areas. So firstly, the chart on the left, what we show here is a breakdown of companies across the market by allocating results from August into one of three categories, being either the company's earnings beat market expectations, their earnings were in line with market expectations, or the company missed market expectations. And you can see firstly in the blue bars, we highlight all the companies that are held within the Lennox Small Companies Fund. And then in the green bars, we show the split across the broader market, which in this case is the ASX 200. And for the market, there's a reasonably even split between each of those three categories. Whereas for the Lennox Fund in blue, there were more companies reporting in line than the broader market, while we also had far less companies miss expectations compared to the level seen across the market. And that, of course, is consistent with our approach to investing in that we aim to find plenty of winners, but we also need to do our best to avoid earnings disappointment. But then we move on to the chart on the right, and that's a far more eventful chart. So what we see here is similar again in that we're dividing stocks into three buckets, but this time we're looking at how forward consensus estimates have moved for next year's earnings following this year's result. So again, we have Lennox in blue and the broader market in green, but the real difference here is that you can see the vast majority of Lennox's investments, almost 90%, fell into those first two categories and saw either upgrades to forward estimates or no change. And again, that's consistent with our approach of avoiding earnings disappointment. Now, the market, on the other hand, as you can see on the far right of that chart, saw over half of all companies have their forward earnings expectations downgraded. And that means the outlook was worse than the market had expected. Now, that has some interesting implications that we'll look at on the following slide, but a key point to remember is that the green bars are representative of the market, being the ASX 200, and they are heavily dominated by larger companies. So now, as we step over to the next slide, we can see what looks to be a really busy chart, but what we're actually showing is the level of earnings growth being factored into market expectations for each financial year at various times in the lead up to that financial year end. So each of those squiggly lines starts around 2 years before the financial year end and captures how the market changes its expectations over the following 24 months or so. So there are several dark green lines that you can see there for FY18 through to FY24. And then the light green line shows FY25, where you can see that initially when that line started, the market was expecting around 5% earnings growth. Now, those expectations then moved up to 10% earnings growth, then down to zero growth, and ultimately ended in August this year at around -3% earnings growth for FY25. Now, linking this chart back to our previous slide, the light blue bar for FY26 shows that when that line started, the market initially expected earnings growth of around -4%. And that rose pretty rapidly to around 5% earnings growth just before last month's reporting season. But following that huge number of earnings downgrades that we saw on the previous slide, the light blue line is now showing that the market expects no growth, so 0% growth for FY26 in the ASX 200. And that's interesting for us as small cap investors because while the ASX 200 is currently showing no growth over the next 12 months, the Small Ordinaries Index is actually expected to deliver almost 10% earnings growth. And that alone should provide some excitement for investors that if you are looking for exposure to not only exciting companies, but also to actual earnings growth, the smaller end of town is where the action is. And I won't flesh out that slide any more than that, but you can see the earnings weakness in large cap is actually pretty broad based, with most sectors expected to be reasonably soft. And of particular note, the big banks who are actually delivering negative earnings growth. So here's to earnings growth over FY26.